Good morning. Adjust this a little bit here. Nothing like starting your morning off with some details on SBA loan financing. This morning, why Tom asked me to come in, or I was lucky enough to get the opportunity to come in, is to give you the overview on the two main SBA financing programs. There's the SBA 504 program and the 7A program. But before we get into those, I figured I'd start out with who we are. Wisconsin Business Development is a private nonprofit organization. We are what's called a Certified Development Company, CDC for short, which just means we've been certified by the SBA to administer the SBA 504 loan program. Reason is the 504 loan program consists of a program where SBA makes a direct loan to the borrower, so they didn't have the resources to underwrite it, service it, and things like that, so they created our program. You can see our mission statement, provide knowledge, services, and resources that foster economic development. We have 8 offices throughout the state. We get in to cover the whole state of Wisconsin and 14 counties in Minnesota. We've been around for 30 years, a long time for any business, but we found out there are about 260 companies across the nation that do what we do. Right now we have about the 6th largest loan portfolio. Normally we finish in about 10 or 12 in volume. So pretty large company, been around for a long time. You can see the next couple slides talks about some performance and things that we've done. We like to put the numbers out because you can see we get involved with a lot of projects. In 20 minutes I'm going to go through some of these pretty fast. So this morning I'm going to start with the 504 loan program. Before we get into the details of it, we got some just general rules from SBA to start with, and these will cover both the 504 and the 7A side. SBA will finance real estate, but what they want to do is finance owner-occupied real estate. So what they say is that the operating company must take a portion of it. If it's new construction on a project, they need to take 60% of the project. If it's an existing building someone's buying, they need to take 51%. And these are kind of hurdles that just make sure that a business would be eligible to start with from the SBA financing side. And then it's the Small Business Administration, so they're going to want people to be deemed a small business in the eyes of SBA. And you can see the test is pretty liberal. We don't really bump into too many large businesses, but what they do is they get tax returns, and they say the business plus any affiliated businesses has to have a net worth of less than $15 million. And then based on the last 2 years of tax returns, the net income has to be less than $5 million. Pretty liberal test. This was actually increased a couple years ago to allow more businesses to be considered small in the eyes of SBA. The next test kind of bucks conventional wisdom in lending. They want somebody to be deemed liquid but not too liquid in the eyes of SBA. So you can see, based on the size of a project, SBA has to have personal resources that fit within it. If somebody has more personal resources than that, then they will have them downsize the project. Again, nothing we run into too often, but those are the big potential tests that you need to meet to be qualified to get an SBA loan. This slide talks about affiliate businesses as part of the test. Next slide kind of gives you a quick definition of what affiliation can be: control, ownership, common management. The biggest one we run into is common ownership. Somebody operates one business, owns a portion of another, large majority of it considered an affiliate business on SBA's side. The 504 program itself, uses of funds. This is a pretty limited program for the uses of funds. You can see it's for fixed assets. So if a business is buying land, constructing a building, buying a building, equipment, all perfect fits for the program. We can also include some soft costs, project-related, things like appraisals, environmentals, general closing costs that would be related to it that we can include as part of the project. If you are putting a building up or buying a building, you can actually refinance up to 50% of the cost. So if a business is buying $1 million building, they can refinance $500,000 of existing debt into the project. The last piece on here, 504 refinance. Unfortunately, we're not going to be able to talk too much about that today. Congress had temporarily allowed us the ability to refinance a complete standalone refinance into the program, but unfortunately that expires on September 27th, and we haven't heard any updates if they're going to extend that or not. So what you can see on the bottom, though, the part that becomes a little bit of a challenge in some projects is there are some costs we can't roll into the 504 program. Working capital, inventory, franchise fees, goodwill, things like that. One of the major advantages of the 504 program is to get borrowers in with less down payment than conventional financing. Typical structure starts at 10%, and what it does is that you have a lender that the business works with that permanently keeps 50% of the loan on their books. That loan will stay with that lender. You'll negotiate the terms as you would any other conventional deal. SBA will come in and fund up to 40% of it, and in this case, the borrower puts in 10%. There are two things that could require a business to put more money into a project. One would be if they're considered a new business. The easy term of startup is if it's somebody in operation of less than 2 years. The other part of it's a change of ownership. And if the ownership comes in and they have unproven management or increased debt on the project, which most of the time on a sale they would, SBA may consider it a startup. The other factor on the down payment side is the type of real estate. If it's considered special purpose real estate by SBA, things like a car wash, a hotel, things that would take a lot of work to modify for some other use to come in, SBA will consider it special purpose. And how that changes the structure. If a business is considered a startup or real estate special purpose, one, you can see that changes the structure by the lender will still maintain the 50%, SBA portion will go down to 35%, and the borrower contribution will go up to 15%. If they're considered both, it changes to SBA providing 30% and the borrower providing 20%. The good news, though, is that a lot of the projects we do get into involve the 10% down payment, which again is less than the conventional financing. As far as loan size, SBA can take on some larger projects. The SBA portion, so that 30 to 40%, in all cases can be up to $5 million. There are a couple exceptions which allow us to do more with a borrower, and manufacturers are eligible up to $5.5 million per project, not an aggregate total per project. And the same as if we can meet some green energy requirements on that side, then we can go $5.5 million per project. Talk about borrower's contribution, that 10 to 20%, where can it come from? Well, easy aside, if somebody has cash, if it's cash that they have in an account or from an equity, you can cash from operations. Sometimes we'll get into if they borrow the down payment, whether it's seller carryback financing, whether it's a home equity loan. The seller carryback financing becomes a little bit trickier because if somebody takes the lien on the project collateral, SBA says they have to have a term as long as their loan. If they don't, which a lot of times ends up going unsecured, then they can do whatever cash flow can support as far as the term goes. We get into a lot of projects that have TIF from a land incentive to kind of come in as part of the construction. We can use that as part down payment, and that can be taken off the appraised value. And if somebody has equity in a real estate, let's say somebody bought a lot 3 years ago and now want to build on it, well, we can give the lot appraised and that equity can go towards the borrower contribution. The terms, probably the other big advantage, the SBA on the 504 portion comes in two terms, a 10-year fully amortizing loan or a 20-year fully amortizing loan. A 20-year loan, obviously, the majority is for real estate. That's the majority of what we do. But we do get into some equipment-only projects where the term is 10 years. There are a lot of projects we get into where it combines real estate and equipment. And as long as the equipment isn't a significant portion, we can do that all over a 20-year term. The other big advantage, we talked about down payment, is the fixed interest rates. Commercial real estate, unfortunately, isn't the same as residential real estate where there's a variety of options to get a long-term fixed rate on it. But you can see on here, we didn't update our rates for August, and we sent this out. But the 20-year rates, as of the loans that funded in August, were real close to this number, came in at 4.45. And then the 10-year rates sell every other month, so that one is still current, but they were 3.7. And again, those are fixed for the life of the term, so it gives the borrowers a chance to access some long-term fixed financing rates in the market. Kind of a hedge against interest rate risk. We put in a couple examples. Sometimes just as easy to see an example as it is to see a paper. You can see in this structure, you've got somebody purchasing real estate, equipment, There is some goodwill involved. We got some working capital and some eligible soft costs. So we would take that and put it together as kind of an example. Well, the first thing we do is figure out what we can and can't include. So we mentioned before that those $50,000 in soft costs were eligible, and you can see they're all project related. There's an appraisal, there's an environmental, some legal fees, interim interest. So while the SBA loan portion waits to fund, we can't include the interest that accrues along the way. So the eligible 504 costs include the real estate, the equipment, and the soft costs. Again, as we talked about before, the ineligible part is the working capital and the goodwill. So for a 504 project, when we total it up, we've got about a $2.5 million project. And in this case, we kind of combine the programs. We'll get into the 7A details later, but you can do a 7A loan to do the things that you can't include under the 504 side, so you can help to finance the working capital and the goodwill. Okay, yep, again, we talked about the 504 assets. So based on the $2.5 million total, what we would do is fund the SBA 40% of that, of $2.5 million of $1 million. We'll get into the more stuff later, but again, we're due to time. So, but you can kind of see again how we take the normal costs, can parcel out what can be included in the 504 program, just at least an example of how a structure might work. You can also see that the programs can be combined. The benefits of the 504 program, when you talk about the lender, because they need a lender involved, well, they get in at 50% loan to value, so they're really reducing their risk. It can free up some capital, improve some liquidity. It gives them some competitive differentiation. From a business standpoint, really lower down payment and fixed rate financing is what it comes down to. Temporary refinance program, I mentioned I wasn't going to talk much on it. Again, what you've got is it expires in September 27th, so there's really not much to say. The SBA did have the ability to take existing debt, refinance it, use the equity to maybe pay down some other business debt, and then have a portion of that locked in. There is some talk in Congress of maybe extending that. Hopefully it will. So there is still money available from the original subsidy. Now into the 7A program. Again, this is a much more fluid program than the 504 side. Basically how the program works is that you have a loan with a lender, and then SBA comes in and agrees to provide a guarantee on behalf of the business. So in essence, if the loan ends up going into default, the risk is mitigated by the government stepping in and honoring their guarantee. You can see, you know, what they do is it's not for people with bad credit. It's just more to help out businesses to offer longer repayments, to get the payments down longer from an amortization standpoint, and really loans that are under collateralized. So still deemed good in a bank's eyes, but maybe just don't fit in the conventional box. SBA loan limit, again, is $5 million on this side, which would get a 75% guarantee. So the maximum SBA guarantee under the 7A portion is $3.75 million. Maximum maturity, you've got, if you have a loan for working capital, you can go up 10 years. Equipment, they'll say useful life, up to 15 years. Normally they cap it off at 10. One of the nice parts of this part is real estate, they can take out 25 years. Again, that helps businesses get some longer amortizations to help out on the initial cash flow side. Interest rates, this part of it doesn't give you the fixed rate. You still negotiate it with the lender, but you can see these are the maximum rates a lender can charge. If maturity is under 7 years, it's the base rate, which more often than not is the Wall Street Journal prime rate, plus 2.25%. Maturity is over 7 years, 2.75%. In today's world, prime is 3.25%, so that gets a borrower rate maximum fund of about 6%. SBA does charge a guarantee fee on the loans. That is built in, it can be worked into the loan, and you can see it's kind of a graduated structure. If you got a loan of $250 or $150,000 or less, it's 2%. 3% from loans from $150,000 to $700,000, and then 3.5% over that $700,000 level. Always keep in mind when we talk pricing before, SBA does charge the lender to have this guarantee. They charge them a little over 0.5%, 55 basis points. So just keep that in mind on the pricing standpoint. Collateral requirements. We talked about one of the reasons lenders use these, and it's a benefit, is for loans that are under collateralized. While SBA's tagline is they will not turn down a deal due to lack of collateral. But what they do is reserve the right to go back and look at everything else that is available. So if somebody has potentially equity on a personal statement, they could come back and ask for that as collateral. But if there is nothing there and they've looked at all sources and the only downfall they see is lack of collateral, SBA has said they won't turn down a loan due to that. So it's kind of one of those nice hurdles that they can get by. SBA does require a personal guarantee from all owners over 20%, pretty standard to lenders. One thing we talk when we talk about available collateral is the first thing they'll go back and look at is a personal residence. But you can see their standard on that is they don't require somebody to take a lien if the residence is already at 75% or more loan to value. With the housing market we've had today, that's not unusual. Life insurance, pretty common side of it, especially in under collateralized deals. SBA will require life insurance on a loan, an assignment of it. So if you do apply for one, don't be surprised if they go on an assignment of life insurance on what they deem to be a key management or the owners. Kind of some specific things SBA can get into that maybe not a lot of conventional lenders can, or at least this will help out. Change of ownership on a business sale. SBA will finance them. They will finance the goodwill, but a couple things. The applicant has to be purchasing 100% of the business. You can't buy 50% of an owner and that owner still have 50% ownership left. You can do it if it's a combination of the two. The tricky part with SBA is that if the seller of the business wants to stay on, they can. They can be a consultant for up to 12 months. But if you have like a 5-year employment contract, that's not going to work under SBA's side. It's got to be a 12-month or less agreement. With the goodwill, they do sometimes require a business valuation. If the amount of goodwill that they are financing is $250,000 or less, the lender can do the valuation on their own terms, their own sheet. If it's over $250,000, SBA requires a third-party person to come in and do a valuation on the business. With the goodwill requirement too, if the goodwill of the business is over $500,000, the 7A loan will require 25% down. This is a little bit of a differentiation from how they normally do. Normally what they want on the 7A side is they want the borrower to put at least 10% into the project. And then after that, it's up to the lender to kind of make the argument if it makes sense or not, cash flow history and things. But the only firm requirement they have is if that goodwill gets over $500,000, they want the 25% down. You can take that 25% in seller carryback, seller equity. Just be aware though, if that's the structure on the 7A side with this goodwill part, they're going to require that seller to be on full standby for the first 2 years of the loan. Give the business a chance to get seasoned and get some history put together. Debt refinance, can refinance debt under the 7A program. You can see it's got to be deemed unreasonable in SBA's mind to be refinanced. So what they're doing is making sure they're not just taking out debt to take it out. Probably the easiest one we run into is debt with a balloon payment is considered unreasonable in SBA's mind, because then there's a big payment that would be due that does not fit into the normal cash flow operations of the business. So SBA only does fully amortizing loans, so a balloon note is unreasonable in their mind. There's a couple other ones, debt with an interest rate that exceeds SBA's maximum. Credit cards used for business purposes, that's a tough one. A revolving line of credit usually is a balloon or an interest-only payment. That makes it unreasonable in SBA's mind. Kind of the catch-all one, debt with a maturity that was not appropriate for the purpose of the financing. And there is actually one that we don't put on that says it is deemed not to meet the needs of the business any further. So that's kind of one way. Usually if there's a debt to be refinanced, there's a way to get it into the bucket. When you refinance debt, the new payment must be 10% less than the old payment, because that's SBA's way of saying that it's going to benefit the business, showing that there is a payment reduction in savings. And if a lender is refinancing their own debt, you got to be careful, make sure that you include the history and that it hasn't been past due for over 30 days. SBA's way of making sure they're not taking out a problem credit. And in some cases, if the borrower currently has a SBA loan, a 7A loan, you can refinance that with another SBA loan. You just have to make sure that you get clarification that new lender is willing to do something then the old lender wasn't. So sometimes it's adjust the interest rate, sometimes it's extend the maturity, but the SBA will require a letter to do that. But it is possible to refinance an SBA debt with an SBA debt. More case studies. In this case, you've got a couple wishing to lease space and open a restaurant. One spouse will keep their job and income. Other spouse will be on staff full-time, on-site management. So we've got leasehold improvements, kitchen equipment, inventory, working capital, and soft costs. And the total they need is $200,000. Borrowers have some cash, $30,000 in cash, and their residence was recently appraised, and they've got a little bit of equity in that. They're at 65% loan to value. They're considering cash out refinance to bring in some additional equity, and borrowing the $30,000 would result in an $80,000 loan to value on their house. So when you put it together, basically you've got the $200,000 of the uses of funds. Nothing like small print on Monday morning. You can see the sources of funds. When their borrower's bringing in their $30,000 of equity, the 7A loan is $170,000. So, and that's option number one. If they were to bring in more money, you can see down there you've got a little bit more equity. But the difference of this one compared to the other structure is that there's one loan when it's done with a government guarantee on that behalf. Another case study, we've got a 504 paired with a 7A on a business acquisition. So you've got someone looking to finance equipment as well as buying out a business for the existing owner. So you've got equipment of $634,000, vehicles of $315,000, some inventory of $200,000, goodwill of $50,000, soft costs of $40,000, initial working capital, and some ongoing term working capital. So how do we break this one up? You've got 504 eligible costs to purchase the equipment and the related soft costs. What we can't include in the 504 is the goodwill, the inventory, kind of the things from the prior case study on the 504 side, and the working capital part. So some things to consider for the business if you run into the situation is a 7A loan program can be submitted to purchase trucks and trailers, because trucks and trailers rolling stock with a title isn't eligible under the 504 program, but is under the 7A side. In this case, I should back up and tell you too, these are all examples that have actually projects we've worked on. So in this case, the local revolving loan fund was brought in to help and actually served as the contribution for the 504 loan. If the revolving loan fund was taking a lien on the equipment, which was part of the 504 project, their term must be as long as the 504 term. And then the acquisition considered a new business, even though it was an existing business, it was new to that owner, so they needed a 15% borrower contribution. So, as you can see, again, hopefully in the handout better, but under the uses side of the 504 structure, we've got the soft costs that were related to the 504 project, and we've got the equipment. So we had $645,000 project. That loan was split out where the lender financed 50% of the project. And again, since it was considered a new project, they needed 15% down. So WBD and SBA financed 35%, and the borrower brought in the 15%, which actually came from the revolving loan fund. And you can kind of see overall down in the bottom, there was a 7A loan done for the vehicles, the inventory, and the soft costs. The borrower did bring in some cash, which helped cover some of the goodwill and some other things. So I guess the reason that we show you some of these examples is just that there are some creative ways to put together structures that may not fit into a box with SBA, and we've been involved with quite a few of them. In the end, my contact information is there. As Tom said, we've been around for a while, and again, been involved with quite a few things. So nothing like a lot of minute details on Monday morning, but again, hopefully that you take out of it that there are some options with SBA that can help on unconventional financing options.